you the trajectory of the debt as a share of GDP. It was more or less very low until the 70s, and then it started to increase in the 70s. But as I said before, the debt in Italy up to and including the first part of the 70s were largely tied to a large expenditure in infrastructures. So a larger debt usually meant more roads, more railroads being built, and this helped the country recover from the war to begin with, and also reduce the regional disparities later on. You know that Italy has a center-north, which is very rich, and the south, which is lagging behind. And the only period in post-World War II when this difference was reduced was in the 60s and the 70s. Then in the 70s, all this stopped, and the policy of infrastructure expenditure in the south was stopped, and it was replaced by some mechanism of transferring funds through the fiscal system from the north to the south. It was more linked to the electoral base and so on. So the debt to GDP started to increase much more rapidly, not because the debt was increasing more rapidly, but because it was not generating more growth, as in the 70s. Then in the 90s, we started to worry about entering the euro. To enter the euro, we had to reduce our debt, to reduce our deficit. So some policies were put in place to reduce the debt, mainly by the first government led by Prodi, the Democrat. And as I showed you before, this was associated with lower growth. This is the equivalent in terms of deficit of the previous chart. This is the change in the deficit. And you can see that it was very low in the 60s, got higher in the 70s, and it's very counter-cyclical. When the recession hits, this increases. When the recession disappears, it gets lower. And if we move to the next chart, this is also, I think, a little interesting. The difference between the interest rate and the growth rate of the economy up to the middle of the 80s was not bad because the economy was growing rapidly. When we started to lower the inflation rate, moving to lower the interest rates became larger than the growth rate. So austerity in this kind of case would not be sufficient because you're paying too much on your debt, then you were able to raise to the growth in income and therefore the growth in taxation. And this is becoming a very severe problem now. And this is the primary surplus in Italy, so we have run a primary surplus for many years, so we have no reasons to be called profligate or to say we're spending too much. Our problem is the interest payment. So to conclude on the interest on the public debt, we don't have a public debt which is too high historically, and the problems in our public debt are not in its size, but on what we do with the deficit. So when the deficit was used to finance infrastructures and growth, the debt was sustainable. If the deficit is used to pay for transfer, this is not. And when the tax base and the ability of the government to collect taxes is reduced, then this is also a problem which I think Italy shares with Greece. So I'd like now to move very quickly to something which has already been covered by Kostas, which is the trade imbalances of the euro. Because this is another important part of the story, but this has already been explained in some detail, so we can go very quickly. There is one part which may be important to remember, which is that the periphery had the same interest rate as Germany, but had a higher inflation rate. So the theory of investment suggests that what matters is the real interest rate, the difference between the nominal interest rate and inflation. So according to this theory, the periphery was enjoying a lower real interest rate than Germany, and this was one of the reasons which allowed Greece or Spain to grow more rapidly than Germany. So it was not just Germany which was leading a policy of low wages, it was also low interest rates which were helping periphery country to grow faster. And so if you look at the evidence, this is similar but not identical to what Kostas has shown, because this is the bilateral trade. And this is showing that Germany has indeed relied on exports, but especially on exports to other Eurozone countries, which had the common currency and could not use a devaluation from 2000 onwards to try to restore competitiveness. If we move to the next slide, this doesn't necessarily imply that Germany was doing well and the other countries were doing badly. If you look at Italy, it is quite clear that Italy was suffering relative to Germany, and the trade with Germany collapsed. But if you look at the trade with the US, there's no reason to think that Italy was doing very badly against other countries. So we also hear a story of low productivity in Italy, of low competitiveness in Italy. I don't think that the evidence is entirely consistent with the story. For Greece, the next slide, in my view, this was a problem. The problem of trade was a problem also because, before the euro started. Greece had a very large trade imbalance, and this trade imbalance was not managed under the euro, and it was the primary cause of the problems that Greece had, including and possibly most of all on the private debt that Greece was applying. So, what is important for my point is that if you enter a trade union and a monetary union like the euro, and in this area one country is keeping wages low and the other countries are growing too fast, then imbalances generate on the trade side. Automatically, if you import more from one country than you export, then you must be borrowing, either from this country or from some other source, but you must be borrowing. So debt is accumulating as a result of trade imbalances. And the implication is that the composition of your portfolio changes. So, for instance, Italy was having 100% of its public debt in Italian hands until 1999. So, before the euro, the problem, so-called problem of the Italian public debt was a domestic problem, which involved some redistribution within Italy. So, if Italians were willing to refinance the government forever, there would have been no problem whatsoever. It was just a decision, a political decision, to transfer some funds from the taxpayer to whomever is getting the interest on the debt. But since this is also always inside the country, it is not creating strong imbalances other than income redistribution. But when you start having a current account deficit, then you are transferring some part of your financial assets to your creditors abroad. And this is exactly what happened in Italy and other peripheral countries. So last year, about 40% of the Italian public debt was held by foreigners. Not just because foreigners were buying directly the Italian debt, but also because the private deficit linked to the current account was implying a transfer of financial assets from the private sector in Italy to the private sector in Germany or elsewhere. So the share of the public debt that was held abroad increased. So now I think we have all the elements to start thinking of, will austerity work, will what